Welcome to Legal 123s with ByrdAdatto. Legal issues simplified through real client stories and real-world experiences. Creating simplicity in 3, 2, 1.
Welcome back to another episode of Legal 123 Birdo. I'm your host, ByrdAdatto, with my co-host, Michael Byrd.
Thanks, Brad. As a business and healthcare law firm, we meet many interesting people in various stages of their business. This season, we get to focus on the high-stakes implications of selling a business. This season's theme is the Hitchhiker's Guide to M&A. We will be guest-heavy and bring in different professionals to offer their experiences and perspectives on M&A.
Yeah, and for those who don't know the vocabulary of M&A, it stands for mergers and acquisitions, and it's slang for either buying and selling a business or buying and selling substantially all the assets of that business.
Way to go, Brad. Well, Brad, I was recently reminded of an article I read and actually saved for you almost a year ago. I think the subject of the article would want to make the owner of the business in that article actually go ahead and sell their business.
Well, first off, I'm happy that for over a year you can remember that far back. So we're very proud of you since your birthday tomorrow. You're turning 709. So you look great, by the way.
I apologize, Brad. I forgot about it and just recently was reminded about this article.
All right. Well, first off, happy early birthday. But second, I'm glad that this article is so important that you had to reach back in that memory bank to pull it out.
Yes, Brad. So the headline for the article is, are you ready? Worker who was accidentally paid 330 times his salary offers resignation and vanishes without a trace.
That is pretty bad. Sounds pretty terrible. And it's, I'm hoping nothing bad actually happened to that worker since he vanished without a trace. So what happened?
Well, this happened in Chile to a dispatch assistant for a cold meats manufacturer. His paycheck was supposed to be $545.
Okay. Well, first, if this was in New York and he was working for a meat manufacturer, I think Rocco and Vinny might have made a visit to this guy and banished him for taking the employer's money. But second, I know that today's guest likes numbers, but I was told there'd be no math today. So what does that actually come out to?
$180,000.
Wow. Did you just do that off the top of your head?
No. Siri. I had the article.
Oh, okay. Yeah. So it was very good.
Yeah.
So what happened after that?
So they apparently, the company, identified the error and asked the worker to return the excess money. And so he was polite and promised to do so tomorrow, the next day. And then he ignored the calls and did not show up for work for 3 days. Finally, surprise, surprise, an attorney on behalf of the worker sent a notice of resignation for him. And the worker has not been seen or heard from since.
All right. So I guess he got away with it?
Well, Brad, I think we have to leave the possibility that you mentioned in New York that maybe they did find him and we just don't know it. But according to Siri, he did get away with it.
Okay.
There's an article in February of this year noting that the worker had disappeared without a trace and the company had not been able to locate the worker to get the money back. So it appears that this guy's living large off his $180,000 payday.
Sounds like a great payday for him. So let's go back to where I started at the beginning of this podcast. What made you think of this from a year ago?
Well, we actually had something similar happen to a client.
Yeah. Our
client called recently to tell us that his practice had accidentally paid a $180,000 bonus twice to an executive of the company.
So asking for a friend here, are they looking for any extra employees right now?
Brad, you're getting distracted again. Okay. That's not the point.
No.
Okay. Yeah. The point is that this person received an extra $180,000 from our client.
So just like the guy in the South America, did he get away with it?
No, money's returned.
Oh, okay.
I'm pretty sure the reason is that the client had better lawyers.
Michael, you're always supposed to say it humbly or in my humility first, and then it's not bragging. But I think you sound like you're bragging there.
So I guess I should not hold up the number one finger while I'm talking about that. No? Okay. Well, let's flip the switch. What is the biggest bonehead financial mistake you have made to cost ByrdAdatto?
So unless picking you as a partner is an option,
Ouch. That's hurtful.
kind of stumped in this question. Honestly, I have, full disclosure, audience, made a ton of boneheaded financial mistakes in my lifetime that are personal. I can't think of one, which I always chalk up as lessons learned, but I can't think of one that affected the firm on this point. What about you?
Well, I have a story. I don't know if you remember this, but when we started our firm, we had big dreams. And when you got big dreams, you want to have a nice, brand new, shiny laptop to go with it.
Oh, yeah.
And so we went and bought Mac Airs.
Yes, we did.
Because we figured that would make us do our best lawyering and best business startuping.
We did.
And I spilled water on mine and ruined it the first month we were open.
Mm-hmm.
And I had to buy a brand new one because the warranty did not cover the water damage.
Yeah, I agree. That's pretty bad. I think you apologized earlier to me. I'd like you to try that again. And Riley, make sure when he apologizes, you just hit it on loop. So every single time I give you the signal, you just say, "I apologize to you, Brad."
Yeah, Riley, you can put this in quotes. No, thank you.
No, don't do that. Don't do that.
Okay.
Well, let's bring on this guest who's been patiently sitting next to you for those watching us on our YouTube channel.
Okay. Once again, we have a friend on. Surprise, surprise. Yes. And a second-time guest. And many who are listening to this podcast will know Ben Hernandez. Ben is the founder and a partner of the SkyTel Group. SkyTel is a strategic financial and M&A advisory firm. Earlier in Ben's career, he worked with an international banking group, with a hedge fund, and financial services and advisory institutions. Even before that, he went to undergrad at Texas A&M. He has a BBA in finance, and then he has an MBA from the SMU Cox School of Business. Ben is married and has a boy named Benny and a girl named Celeste. And we're very glad you're here today. Ben, welcome.
Thank you guys for having me. That was an interesting story, by the way.
Yeah, well, first off, I think we have to let you know that, if audience members remember that this is the Hitchhiker's Guide to M&A. And, one of the questions I think probably everyone wants to know right now, Ben, is have you accidentally ever overpaid any of your employees? And if so, do you have any job openings?
Not accidentally, but, given my job, I don't believe in the term overpayment. So we are hiring right now. So if you're asking for a friend, let's just say his name is Brad. I think, probably current market comp for Brad is $1 billion or so a year, I would think.
Yeah, that sounds very reasonable, actually.
Yeah, right. Yeah, Brad, you're just, how to butter Brad up. Well, I'm glad we got that cleared up.
Yeah, I feel better.
Yeah.
Agreed. So like Michael, for context, which we all know that you love, we talked about different seasons of a business. And then we also talked about the 5 phases of M&A. Maybe for our audience members who are hearing this for the first time, just give a quick recap so we can then bring Ben on.
Yeah. So we are really honing in on M&A this season, and it can become easy to get caught in the weeds.
Yeah.
And so you take a step back and really, we want people to understand that every business is in one of 4 seasons. They're either in the building season, so they're getting things going, they're creating infrastructure, or they're in the operating season, which is the day-to-day grind, and they're getting their processes done and navigating the different fires and crises that pop up.
Yeah.
Or they're scaling. That's another season. At that point, there's any number of things that are happening for them to grow, whether that's through hiring, opening new offices, raising capital to help fund it, all sorts of pretty heavy activity.
Yeah.
And then finally, there's the buying and selling season. So you may be buying a business to add on to your business, or it's time for your exit.
Yeah. And that season tends to be heavy on the M&A side, and we kind of break that up into 5 phases.
Yeah. And so when you're talking about M&A, you're the 5 phases of an M&A transaction, or you have the letter of intent, or the LOI, as we say on the streets.
Yes.
Due diligence, definitive agreements, which is the legal paperwork.
Yeah.
And then you have a closing, which is a little less ceremonious these days than it used to be, but it's the final part of the deal.
Yeah.
And then you have kind of post-closing obligations that arise. But for today's show, we're going to kind of spotlight the due diligence phase.
Yeah. And speaking of LOI, Ben likes it so much he has a tattoo on his bicep. So the next time you're seeing Ben, just make sure you see the LOI tattoo. Well, Ben, we're excited that you're with us today. And before we really jump into this second phase of due diligence, talk a little bit about SkyTel so that the audience members understands why, why are you here then, I guess, right?
Yeah, I'm not sure exactly why I'm here, but SkyTel, what we do two things. We do management consulting, and that you can kind of think of when we were talking about the phases earlier. The scaling phase is really where our clients utilize us, where they're typically growing, scaling their organization. So they're professionalizing it. Think of it as business building. That's not as much as what we're here for today. So I'll move on. The other piece of what we do is we do sell side M&A, which means that we represent our clients as we take them to market. And typically the buyer avatar for them is going to be either a strategic, which, generally speaking means a group that's backed by private equity but already built out, or we're selling to private equity or family offices themselves.
Very cool.
Awesome. Well, let's kind of shift into kind of the M&A process, and the first part, at least the way we talk about it, is the LOI and the LOI negotiations. But talk about how your perspective on that. That'll help us build up to some due diligence questions, and even maybe talk about what you do, prior to the LOI with your clients.
Yeah. So in order to even get to the LOI phase, the way that we like to work with our clients is, I think we can break it down into generally 4 phases. And phase 1 is going to be, think of it as internal building and marketing. So what that means is, before we show our house, if you will, think of it as selling a house. You probably want to stage it, right? You want to take pictures of your family out, things of that nature. You want to be sure that when someone walks in, the bed is made at the very least. So what we're doing here is we're building what's called a virtual data room. And essentially what that is think of it as a vault of documents of everything we know buyers are going to ask for: accounting information, finance, tax documents, legal documents, formation documents, anything you can think of. We gather all the things that we know buyers will ask for. The second thing we're doing, some of the marketing piece, it's called a SIM. Basically, it's a 50, 60-page book on your business. It describes your business. It describes the leadership within it, the owners within it, what preferred deal structure might be, historical and future earnings. The goal there is that when a buyer reads it, they could, in theory, put an LOI right in front of you. They don't, but that's the goal that we're aiming for here. When all that is ready to go, we're ready to go to market. And now we're getting into the IOI phase. I'll define that in just a second. When we have all that ready, we present our client with the buyer list. By then, keep in mind, we've talked to our client. We know, generally speaking, what that ideal buyer is going to look like for them. So we put together a list. Typically, it's 30 to 60 buyers that we pitch to. And when they say it's good to go, we turn it on. We turn it on the same day. And the thought here is, if you have 30 to 60 eyeballs looking at you, you're going to get not only the right valuation, but the right deal structure as well, and the right partner for you personally, because you'll be spending the next 4 or 5 plus years with them. So at this phase, we're highly protective of our clients' time. Typically, our buyers aren't talking to them at this point in time. We're answering questions on their behalf. And then we get the IOIs. We set a specific date. So what is that? It's an indication of interest. And generally what that means, it's not an LOI. It's a very loose letter that states, based on the things that I've seen, I'm going to value you in this range. Here is a theoretical potential deal structure of what you should expect from us. What we do then is, let's say we have 10. We'll take 10 IOIs side by side and try to compare apples to apples. Valuation, deal structure, non-compete, non-solicit terms, and a little biography on each of the buyers, with the goal being, now we're about to go into the LOI phase, and our client needs to tell us, let's just say that they want to talk to 8 of the 10. These are the 8 of the 10 that look reasonable. Let's go there. Our job then is to call the buyers and let them know you've made it to the LOI round. And what happens there is management meetings potentially where we update the buyers on the last few months of the business, in addition to a dinner and a site visit's pretty typical. This is where the buyer also gets to interact with the seller and vice versa, and they can both do diligence on one another, with the goal being coming out of that meeting. Think of all the work you've done ahead of this. The goal is that the buyer put a very solid LOI in front of you, the seller. And that's when we get the LOIs. We get them a couple weeks after that. Final negotiating points. And ideally, this is when we like to joke with our clients. This is where we try to make their life difficult, where if we have a few really good, solid LOIs for them to choose from and, partners that they really like, and then you sign the LOI and you go into exclusivity, which basically means you're engaged, getting ready to get married over the next 90 days.
Well, and I have several follow-ups, but I know we have other things to cover. And I think when you were talking about a lot of different points, which were all great. Probably the one question I think most people want to know is who pays for that dinner?
Yeah, it should be the buyer.
Yeah,
Although
okay.
we've had one slipped up and we had to pay for it.
Yeah,
Definitely not the seller.
I think that's a good point, because if you show up and they want to buy you and they're staring at you, I'm like, I don't know how this is going to work out if you're not going to buy me my dinner too, right?
Yeah, maybe they don't have capital.
Right.
Might be a problem.
Exactly.
Red flag.
Exactly. That is a red flag. And that's, that's just stage one of this LOI. And, you were talking about what really you were preparing them in that prior even to going to that stage of really getting their house in order, as you described it. Because what they don't realize is once that LOI is inked, this is when they move that next level, which the phase that we call the due diligence phase, which is our term of art. We always talk about it being the underwear drawer moment, where you had to open the underwear drawer and show the good, bad, and ugly. So I guess in your analogy, you got the house in order, but you shoved all the crap in the back room, and you don't, once you open it, it all comes falling out. You're like, this kind of looks bad. But from your perspective, one of the areas that you really focus on is really doing a deeper dive on their financials, because that's what the seller wants to see. Is like, hey, this is what you said you're worth, and now we want to really get a better idea. And a term of art that we hear often in this industry is Q of E, or quality of earnings. And then during this due diligence process, tell us, our audience, what they should expect during this M&A deal when that happens.
Oh yeah, this is a big point we discussed with them very early on. And first of all, I resemble that remark. If you're talking about the house, it sounds just like my house. But yeah, so what quality of earnings is, to your point, when you ink the LOI, the very first thing that happens is the financial diligence part of due diligence. And I've always thought that the reason that it goes first is if there's a possibility that a deal is going to fall apart, it's at this point in time.
Mm-hmm.
Usually if we get over Q of E, we feel pretty good about ourselves. But quality of earnings, it's basically the buyer hiring an accounting firm to effectively redo your financials almost. They're assessing and analyzing the quality of your revenues, expenses, and ultimately down to your EBITDA historically, and they're providing that report to the buyer. So, to people listening, wait a minute, we've already provided the buyer all this information, right? What's going on here? So let's keep in mind, we play in the lower to lower middle market, which means there's high variability of the quality of work done on accounting. So what this firm's going to do, let's start at the revenue level. They're going to typically change it from cash to accrual accounting. So what does that mean? Let's say that I leave here today and I say, hey, Michael, Brad, I have a few legal things coming up. Here's a $75,000 check. I'll go ahead and just leave it here.
It's a great idea.
Keep going. I like it.
If you're on cash accounting, you're going to be looking at this month's revenue and it'll be there. If it's on accrual, however, they're going to say, wait a minute, you have Ben's check here that you've cashed, but it's going to go as a liability on the balance sheet because you haven't done the work. As you do the work.
Oh, wait, did you want us to work for that 75? I thought you were just giving it to us.
Ideally.
Oh, okay.
Ideally.
So needy.
Oh, yeah, I hear that a lot. So what they'll do is they'll adjust that revenue downward in this case because you haven't yet earned it. Expenses are usually where the adjustments come into play. So really popular ones really quickly would be owners. These are founder-owned businesses. Typically, they pay themselves every which way. You're going to adjust for market. So think of the get hit by a bus theory. If we had to replace you today, what would you cost at market if you weren't an owner? Some of the clients will own their land and building. So we adjust for market rent. One-time expenses are adjusted for. Personal expenses, like I know ByrdAdatto, I see ByrdAdatto yachts and jets everywhere.
Obviously.
So those would be added back because it's not normal operating activity. And then you get to normal
Whoa.
EBITDA.
That's not normal?
I mean, in ByrdAdatto's world.
Okay,
But that's like top 0.1% of the world ever. So then you get to adjusted EBITDA, and hopefully everything is fine. However, 2 points here. One, if your EBITDA is actually higher, buyer's not ever going to call you and say, hey, turns out I owe you $1 million. However, if it's lower, let's take an example of a $100,000 EBITDA drop, which think of all the adjustments I just mentioned, not very unrealistic depending on deal size, but it doesn't sound like a lot either, does it? But when you talk about market multiples, you're talking an adjustment of $600 to $1.1 million on a valuation level. You're probably going to get a phone call to come back to the table. So that's where the buyer's quality of earning comes in. And you know, there are ways to safeguard against that if you're a seller.
So one follow-up question for the audience, because Brad and I would really butcher. I know Brad would.
Yeah,
I would probably get us 75. Tell the audience what EBITDA means.
Yes, so EBITDA is earnings before interest, taxes, depreciation, and amortization. And effectively what that means is you're taking your net income and adding all those things back because they're basically accounting and tax decisions that mess a little bit with the actual earnings of the business. So it's a very rough, it's not perfectly cash flow, but it's a rough way to estimate what cash flow of the business is.
Yeah.
Gotcha. Cool. Well, so let's kind of move on to the next thing. Are there things kind of jumping off on this Q of E conversation? Are there things that the sellers can do proactively to best position themselves for kind of the best outcome here? I'm kind of thinking back to how your beginning phases before you took the client to market.
Yes. So very early on, we mentioned buy-side QB because it's a big deal. Our first suggestion, and it's not for every business, if the deal is too small or not very complex, maybe not worthwhile or worth the investment. But 95% of the time, our suggestion is that our sellers at least consider doing their own sell-side quality of earnings. This has a few benefits. One, at this point in time, you as a seller know exactly what your EBITDA should be. By the way, as mentioned earlier, oftentimes the EBITDA is actually higher than we think or you think. So that's not uncommon. Number two, it allows the buyers to then have much more confidence when they're putting forward an LOI, a bid for your business, because they know that this has been vetted. And, you know, do buyers bring you back to the table? Some do. Do they enjoy it? Most do not. It's not a pleasant conversation when you're trying to close and partner. So it gives great confidence, which therefore the third benefit is it increases your probability of closing. So this is a long process. You know, having it fall apart is usually an emotional and psychological drain on you as the seller. So that's number one, what we would suggest. And if something does go wrong at the QV phase, guess what? The two quality of earning firms can speak together to figure out where the discrepancy is. And sometimes it's on their side, not ours. If that's not an option or of interest to our sellers, the other thing I would suggest would be at least work with someone who knows how to quasi get you there. All the adjustments that we mentioned earlier, like if our clients don't want to do it, what we do is we try to do as best we can a poor man's version of it. We're asking them, we're going through the P&L, asking them, is this personal? Is it not? What's this one-time looking expense? Show me your gift cards, your prepaids. These are some of the revenue adjustments from an accrual perspective. So we can talk to them about what to expect there to at least come up with, and then rent, of course, we mentioned, to at least come up with what we think is an adjusted EBITDA figure to at least get us closer. But those are a couple of things if you're about to go to market. If you're thinking of going to market, but you're saying, I'm 2-3 years away, then my suggestion would be get a really high quality bookkeeper or CPA who understands the industry and ask that they do your books the right way because you are thinking of selling someday down the road.
Did you, and I know we probably only have a few minutes left, but part of that process when you're trying to onboard with someone, would you talk to them about moving from cash to accrual? Because it seems like most small businesses are cash based. And is that a hard conversation when you're trying to tell someone to do that switch?
It is a hard conversation. Usually they would have had to be a client of ours, and that trust has been highly, highly established because it's a very different way from looking at your business.
Yeah.
You're not looking at your bank account, basically. You're looking at, have I produced the work and so forth. There are times when we suggest it. We try to be very conscious of the expense and everything else that goes with accrual accounting. Usually we suggest looking into that when you're at about 3 to 5 million of EBITDA. So, roughly translate that to 10 to 20 million, top line revenue, and you're still growing and you're still interested in scaling. That might be a good time to start researching it. Even outside of selling the business, if you're looking at raising capital, Michael mentioned that before on the scaling. If you're thinking of raising capital, doing things of that nature, some banks at that level will ask that you flip to that anyway. So we try to be very careful. It's not for most, but if it's a significantly sized business, it would be something worthwhile.
Yeah.
Well, Brian, I'm going to give you credit for actually asking a good question. I mean, you can almost go home now.
I thought you gave it to him, Michael.
Well, you saw the note.
Screw him about.
Oh, well, Brian, I tried to help you. Okay. All right. Well, we have quickly ran out of time. That was awesome.
Yes.
So, Ben, thank you for joining us for the second time on the Legal 1, 2, 3s with ByrdAdatto. We are grateful for you. So what we'll do next is we'll go to break, and then Brad and I will come back on the other side and offer some legal insights.
Thank you so much for having me. And what do I need to do to get a third time?
Ooh. Well, that'll be on employment law.
Oh, perfect. I'm an expert.
Many business owners use legal counsel as a last resort rather than as a proactive tool that can further their success. Why? For most, it's the fear of unknown legal costs. ByrdAdatto's Access Plus program makes it possible for you to get the ongoing legal assistance you need for one predictable monthly fee. That gives you unlimited phone and email access to the legal team, so you can receive feedback on legal concerns as they arise. Access Plus, a smarter, simpler way to access legal services. Find out more. Visit ByrdAdatto.com today.
Welcome back to Legal 1, 2, 3s with ByrdAdatto. I'm your host, ByrdAdatto, with my co-host, Michael Byrd. Now, Michael, this season our theme is The Hitchhiker's Guide to M&A. And today's show, we had our guest, Ben Hernandez, join us. And we were kind of, I use the term and art of, we were talking about the underwear drawer phrase. You like to call it the proctology exam phase, but we're really talking about due diligence. And, and Ben brought up really the focus of the financial aspects of due diligence, and really the focus on quality of earnings analysis.
Yeah, I mean, just to recap, I'll take us from 50,000 feet down to Ben, and quickly. I mean, we started by talking about every business is in one of 4 seasons of a business, and then if you're in that 4th season, which is you're buying or selling a business, that's really where we're talking about mergers and acquisitions. And then even Ben drilled down there and really talked about, his journey when they're helping someone as a seller trying to take things to market. And there's, getting the house in order from their view of the world. And that's, getting the documents together and getting the financials together. And then, you have this process that gets you to a letter of intent. And then we get to this time period where there's due diligence, and it starts as, with the financial due diligence. And it was really fascinating because, Ben broke down, this term that we all hear and we just kind of run from because we don't know what it means. Q of E. We think, oh, that's fancy.
Yes, they're fancy.
Quality of earnings. And I loved how Ben broke down for us today. Really, what we're trying to get to is the buyer wants to understand what the cash flow is, and they're trying to weed through all the ways that you have reported your income and your expenses and get to the true number.
Yeah, and Ben was talking about certain things that they might start looking at. So other things that during this phase that may impact, again, the way the guys with the fancy little hats on or the bean counters start looking at stuff. There's so many things they could be looking at. Could they be looking at your liens or other encumbrances? Could they be looking at certain employment contracts that have certain guarantees that are part of it? Are they going to look at litigation claims and potential outcomes of those claims? I know that regulatory compliance, we talk about all the time. I was part of a deal where it blew up because they couldn't quantify what the impact of that would be. They might be even looking at other aspects. Are certain documents missing, but they know it exists? And how does that then impact the matching numbers? Ben mentioned, like, he didn't say Groupons, but other gift cards and stuff like that can kind of deal with it. And then maybe you have so many investors that can convert their ownership, or you have options, or you have large loans out there, everything like that. And that's why I think what Ben said in the very beginning was so important. If you have your house in order beforehand and you know what's out there, that actually will help you either clean it up before you go to market, and then how it most likely have a higher impact on the overall valuation. But Michael, we're really almost at time. So what are some of your final takeaways?
Yeah, I mean, if you think about, the way we started today was someone got overpaid $180,000. Sometimes those gotchas come up in the Q of E phase, and those are big deals to deal with. But I loved how Ben talked about there are things you can do to prepare and make sure everything's in order. And oftentimes it's not the big gotcha like that.
Yeah.
It's what is the quality of the way you're reporting your income on your books? Money's coming in. Do you have someone that knows the industry and is accurately capturing what that is, so that later when you're doing a Q of E, you can more quickly get to the real number. That's the goal, is to get to the real number. And we've just seen through all the deals that we've done over the years that that can be the real, kind of hiccup, is the deal falls apart because, the buyer thought they were getting X, and it turns out that it was really something less.
Yeah, absolutely. Well, audience members, that's all the time we have today. Next Wednesday, we have Dr. Rachel Walker joining us as we continue down this journey of the Hitchhiker's Guide to M&A. And we're going to learn her perspective of being on the buyer side of a medical business.
ByrdAdatto is providing this podcast as a public service. This podcast is for educational purposes only. This podcast does not constitute legal advice, nor does it establish an attorney-client relationship. Reference to any specific product or entity does not constitute an endorsement or recommendation by ByrdAdatto. The views expressed by guests are their own, and their appearance on the program does not imply an endorsement of them or any entity they represent. Please consult with an attorney on your legal issues.